The stock market just blasted into all-time high territory again. I mean, look at these numbers. But right beneath the surface, a massive trap is snapping shut on everyday retail investors. Well, big tech is out here playing this dangerous game of musical chairs. We are seeing a brutal, and I mean brutal, collapse in consumer data. It's screaming that your portfolio might be skating on incredibly thin ice right now. We're witnessing this terrifying economic split, and let me tell you, the next 2 weeks, they're going to force a serious reality check. Number 1, the all-time high illusion. The major averages look absolutely bulletproof right now, don't they? But man, it's just an illusion. We literally just watched the S&P 500 close at an astonishing 7,580, and the Nasdaq, it surged nearly 1.75%. But please, do not let these green screens fool you. What we are actually witnessing is this persistent, super low volume melt-up, fueled entirely by algorithmic dip buying. It's completely ignoring the structural cracks that are widening in the real economy. It leaves us asking the big question: can a handful of tech stocks really carry the entire financial system on their backs? Section 2, the AI infrastructure lifeline. To really grasp what's going on, we have to look at the one thing keeping this market afloat right now. Look no further than Dell Technologies. They just dropped an absolute monster of a first quarter earnings bomb. Their revenue skyrocketed 88% year over year, hitting nearly $44 billion. And it perfectly illustrates exactly where the smart money is flowing. A staggering 757% surge in AI-optimized server sales, 757%. Enterprise buyers are just aggressively dumping massive capital budgets into AI, totally obliterating Wall Street's expectations. But hold on, because beneath this surge is a massive contradiction. You've got Dell trading on this incredible run rate, boasting a 3-year free cash flow growth of positive 148%. Amazing, right? But then contrast that with Hewlett-Packard Enterprise. HPE just hit all-time highs this week, even though their free cash flow completely collapsed by a negative 57%. So what does that tell us? Institutional money is blindly chasing momentum. They are completely ignoring fundamental cash flows. 3, the ghost town consumer. We need to abruptly shift away from this tech boom and look at the dark side of the economy, the data that Wall Street is practically begging you to ignore. First quarter GDP was just revised down to a sluggish 1.6%. And actually it gets worse. Real after-tax disposable income fell 1.1%. That is literally the worst annual contraction in purchasing power we've seen since the Great Recession. To keep up with this sticky inflation, everyday Americans are aggressively draining their bank accounts. This has sent the personal savings rate plummeting to a dangerously low 2.6%. And look, historically speaking, whenever this indicator collapses to these levels, a massive, violent pullback in consumer discretionary equities is right around the corner. So how does all this consumer exhaustion actually impact your wallet? Well, if your 401k is heavy in standard index funds, you're sitting on massive, hidden mega cap risk right now. On top of that, collapsing volatility premiums are absolutely crushing option riders. We're at a point where retail investors are literally having to choose between buying the dip or paying for groceries. And major retailers are explicitly warning us that their gross margins are under attack. Guys, this is a massive hidden portfolio trap. Number 4, the ceasefire shockwave. Because just when you thought this picture couldn't possibly get any more complicated, a sudden geopolitical shockwave hits and completely scrambles the math for the Federal Reserve. We just saw a frantic sequence of events unfold. A secret situation room meeting led to a tentative 60-day U.S.-Iran ceasefire negotiation. The immediate result? Brent crude instantly plunged over 10% in a single week. Now, this massive drop in oil, yeah, it throws a temporary lifeline to corporate margins, for sure, but it also throws a giant wrench straight into the Fed's monetary policy. Why? Because at the exact same time oil is dropping, newly sworn-in Fed Chairman Kevin Warsh is taking the helm just as the Chicago PMI explodes. It hit a massive 4-year high of 62.7. That kind of number signals intense localized manufacturing strength, and it creates immense macro tension. You know why? Because it keeps rate hikes firmly on the table, heading right into the crucial June interest rate meeting. Section 5, bulls versus macro bears. All of this data has ignited a vicious battle that's currently tearing Wall Street apart. We've got two entirely opposing forces colliding head-on. On one side, you have the bulls. They are aggressively betting that this enterprise AI build-out is a structural supercycle, that it's somehow completely immune to macroeconomic gravity.
They're looking at that drop in oil and seeing the perfect catalyst for massive profit margin expansion. But on the flip side, the macro bears are shouting from the rooftops that a vanished savings rate, combined with overheating regional manufacturing, absolutely guarantees a severe economic slowdown. To them, this current rally is just a total mathematical illusion.
And adding a super heavy layer of fear to that bear thesis is this specific piece of data. Core PCE inflation is stuck. It's completely stuck at a hot 3.3%. And with inflation remaining this sticky, the Fed has absolutely no room to pivot. None. They can't step in to offer relief to a struggling, tapped-out consumer, even if they wanted to. 6, the final market verdict, which brings us to the ultimate climax here. Based on the stark K-shaped divergence we're seeing, there are 2 distinct forward-looking scenarios that are going to determine the fate of retail portfolios over the next month. Scenario 1, we've got a 60% probability of a tech consolidation breakout. This is where growth indices digest those big May gains, and institutional money that's currently hiding out in defensive stocks aggressively rotates back into tech right before the June FOMC meeting. But scenario 2, there is a very real 40% probability of a consumer stagflation trap. In this scenario, the extreme weakness we see in retail stocks spreads out into the broader industrial cyclical sectors. Organic revenue stalls out entirely, forcing a much deeper market-wide correction. It all cuts straight through the noise, doesn't it? It exposes the fundamental flaw in Wall Street's whole narrative right now. The market is treating AI like some kind of economic savior, but they are completely forgetting one massive reality. An economy cannot run on microchips if the human consumer is entirely broke. So the huge question you have to answer for yourself right now is this: tech consolidation breakout or consumer stagflation trap? Where is your portfolio hiding? Get down in the comments section right now and let's debate this. Which of these 2 scenarios do you think is going to inevitably crush the other in the coming weeks?
An investment in knowledge pays the best interest, so why not invest in this channel? Click like and subscribe for more.